today we're looking at an analysis arguing NIO's fundamentals are stronger than ever, trying to put that recent stock dip in context with its huge growth and triple brand strategy.
Okay, let's jump right in. That expansion plan, the three-headed dragon, it's the absolute heart of the bullish case here.
It is. It's the core of the long-term argument.
But whenever you introduce simultaneous launches, across brand new markets, new segments, you're also introducing just a massive amount of execution risk.
And that's where we see the first opportunity. The material does a great job highlighting the three brands, NIO Premium, Envo for the mass market, and Firefly for Europe. It paints them as these pure growth drivers.
Yes, but to fully establish that long-term strength, the report really needs to address the inherent risks in that strategy much more robustly.
The competitive overlap, the capital burn.
Exactly. So here's the weakness. The report talks up the $5.1 billion cash reserve, which is a huge strength, right?
Of course.
But it never connects that cash pile directly back to the capital expenditure that this huge expansion is going to demand.
So it's a disconnect. You're failing to model the potential strain. You've got three different product lines ramping up at the same time.
Right, two of which are in brand new, super competitive segments.
And suddenly that $5.1 billion, as big as it is, needs to be looked at through a lens of, potential margin dilution and just sustained cash burn.
Precisely. Any sophisticated investor is going to look at launching a premium brand, a mass market brand, and an export brand, all in, the same 2-year window?
They'll immediately question the execution.
They will. And if the analysis just says, hey, we have $5.1 billion, without addressing that capital intensity, the whole bullish case just feels a little naive.
I see that, but isn't the cash buffer itself the point? It's enormous. Is just showing that safety net not enough without getting into speculative CapEx models?
It doesn't need a super detailed financial model, no, but it does need to show resilience.
Okay.
So the suggestion here is to integrate a specific section that proactively hedges this risk. You need to model, even roughly, the capital demands against the reported Q3 gross margin and that cash runway.
So you're not just saying the cash is a lump sum, you're framing it as a strategic war chest.
That's the key. You have to make the cash active, not passive. You're answering the skeptical question before it's even asked.
Okay, so give me a concrete example. How would you do that? Well, one simple way is to just briefly calculate how that cash runway changes if ONV and Firefly require, say, capital deployment equal to last year's peak spending.
Ah, a stress test.
A stress test, exactly. If you can show that even under that stress, the $5.1 billion still buys them, 10 quarters of aggressive ramp-up, you've just massively increased confidence.
And what about the competition? You mentioned Firefly being the Trojan horse for Europe.
Yeah, that section is just too brief. Global expansion is incredibly expensive and difficult.
For anyone.
For anyone. So the analysis has to acknowledge the landscape. When you talk about Firefly, you need to at least briefly mention the established European players.
The German luxury brands, their own EV shifts? Right. You don't need a whole competitor breakdown, but just acknowledging that the analysis has considered the difficulty, it shows the planning is robust. It's not just wishful thinking.
That makes a huge difference. It changes the strategy from an optimistic projection into a risk-adjusted plan. I like that.
And building on that, let's talk about the structure of the report itself. I saw an issue that I think really undermines the conclusion.
The transition from the financials to the charts.
Exactly. The flow could be so much stronger if it logically connected the fundamental data, that cash, those margins, to the technical analysis. Right now, they feel like two separate things.
Yeah, the weakness is that structural leap. The material builds this fantastic financial case, right? You've got the 14.7% vehicle margin, the $5.1 billion in cash, real, tangible value.
All solid stuff.
And then it just jumps. It just pivots straight into a technical discussion about the $5 psychological support zone.
With no bridge. It reads like two different reports that got stapled together by accident.
It does. And a support zone on a chart is just, lines on a screen until you give it a fundamental reason to hold.
That's the question an investor asks, isn't it? Okay, the stock hits $5. Why should it bounce here?
Right. And if the analysis doesn't use its own financial data to answer that, the technical part feels arbitrary.
Random. So the suggestion is pretty clear. You need to structure the technical section as the logical outcome of the fundamental strength. Use that cash position to justify why that support zone should hold.
So the chart is a reflection of the balance sheet, not just something happening at the same time.
Think of it like a journey for the person reading this. You build the case with hard numbers, and then the technical analysis becomes the entry strategy that's derived from that strength. It's the so what.
And a great way to do that is with a really strong transition. So instead of just starting a new section, you could rephrase it to say something like, given the 5.1 billion cash safety net, which lets them weather price wars, that technical support at $5 isn't just psychological.
It's fundamentally sound.
Exactly. It represents a classic buy the dip entry point based on tangible value.
That framing is perfect. It immediately ties the chart to the value you've already established. It turns a technical level into an expression of the company's durability.
And the Q4 delivery targets play into this perfectly.
Oh, absolutely.
They need, around 43,000 deliveries in December to hit guidance? That is a massive fundamental catalyst that's right around the corner.
And that catalyst has to be explicitly linked to the technical idea of a pre-earnings run-up.
It's not just a hurdle they have to clear. It's potential momentum.
You have to state clearly that the technical consolidation, the sideways action, is happening in anticipation of that financial catalyst. That justifies what you're seeing on the chart.
It makes the technical analysis so much more authoritative. It's predictive, not just descriptive.
I completely agree. Now, my final point is a bit different. It's about the voice of the piece, the overall tone.
Okay.
While the data is super strong, that 76% year-over-year growth is powerful. I think adjusting the language would really enhance the analytical weight of the report. It would help it appeal to a much broader, more sophisticated group of investors.
You're talking about the confidence in the tone? It's very energetic?
Energetic is a good word for it, yeah. But the title especially, Forget the Noise. NIO's fundamentals are stronger than ever, with the strong arm emoji.
A little promotional, maybe?
It's promotional and a bit confrontational. And that style, works great for a quick video or maybe a newsletter trying to generate hype.
But for an objective analysis report,
It risks undermining the credibility. It can come across as zealous promotion instead of clear, objective rigor.
But hold on. Doesn't that title grab the attention of the exact people selling on the dip, the short-term traders? Are you sure you want to sacrifice that hook for, pure analytical dryness?
That's a fair challenge. But think about the target reader for a report focused on a 3-brand strategy for 2026.
You're looking for longer-term money.
You are. And if the tone is too confrontational, telling the market to forget the noise, it can create resistance. Experienced analysts want the data to do the talking, not the framing.
So it's engaging, but it might be labeled as biased from the get-go? It sounds more like an emotional appeal than a data-driven one.
That's it exactly. So the suggestion is to keep the bullish energy, but shift the framing. Move away from emotional dismissals like noise and toward the clarity of what we could call the signal.
Let the evidence speak for itself.
Let the data create the impact. Focus on the contrast in the data.
Okay, give me some concrete examples of that. The title and the intro.
For the title, replace it with something that emphasizes the hard data and the strategy. Something like NIO, Q3 margin breakthrough and the triple brand strategy for 2026.
That immediately signals a serious, forward-looking analysis.
It appeals to investors interested in structural improvements, which is what the report is about.
And the intro?
For the intro, instead of focusing on the panic selling or calling out short-term traders, just center the hook on the contrast in the numbers.
The 10% month-over-month decline versus the 76% year-over-year explosion.
Exactly. Juxtapose those two numbers right at the top. Let that massive contrast drive the engagement.
That way, the reader concludes on their own that the dip is noise, based on the evidence you just showed them.
Precisely. The most persuasive analysis lets the reader discover the conclusion themselves. It feels earned. And that shift in tone just boosts credibility immensely.
This has been really productive. It's a strong core thesis, the data is great, but the presentation and tone just need that final polish.
I agree. So to recap the main suggestions, first, bolster that risk assessment. Show how the $5.1 billion in cash can handle the stress of the 3-brand expansion.
Second, integrate the financials and the technicals into one cohesive argument. Make that chart support level feel fundamentally sound, backed by the cash position.
And third, refine the tone. Prioritize analytical credibility. Let the signal and the data speak louder than any promotional language.
This is a very robust argument that's ready for that next level of refinement.